It's now almost a week since Donald Trump won the election. He is now the 47th president, or will be the 47th president of the United States come January. So, how have markets been doing over the last week? Well, historic rallies in risk assets. S&P 500 just today on Monday reached a new high, 6,000 points, unprecedented. The Nasdaq's up. Tech stocks are up. Bitcoin just last night surpassed 80,000, unprecedented. The DXY spiked the day Donald Trump won, so we'll talk about the dollar. Gold is down off its highs. The 10-year has been rising. It's now inching towards 4.29%. 4.3 was the latest number. Gareth Soloway is here to break down what's going on. He is a chief market strategist and president of Verified Investing. Welcome back, Gareth. Crazy times. All I can say is wow.
Yeah, I'm with you. And thank you for having me back, David. It's great to talk again. Incredible rally. I expected Donald Trump being so pro-business that we get a rally. Did I think we were going to get this type of rally? No. Did I think Tesla was going to zoom up at that much? What it's doing is incredible. But you know what? This breeds opportunities for people like me, shorter term investors and traders, because you get outsized moves that at some point we'll have to retrace. And we can touch on a lot of these charts, but it's pretty amazing.
I just want to start with the broad markets first. So let's do S&P 500 and then Russell, and then we can touch on the other asset classes, Bitcoin, gold, the dollar, Tesla, any individual stocks you want to touch on. But broad markets first. Like I mentioned, Gareth, 6,000 points. This is a new all-time high. We've seen nothing like this before. This is a new number. People have been talking about 6,000 points for a while like it's a unicorn, and here we are.
Yeah, and interestingly enough, it took 3 years for the S&P to go from 4,000 to 5,000, just 1 year to go from 5,000 to 6,000. So you definitely see this kind of speeding up of gains that we've seen over the last year or so. And again, here we have the S&P chart. And again, you can see the massive move since the elections just up to the upside. Now, granted, this is getting outsized, meaning it's getting a little bit extended. At some point, we'll have a retrace. I've been having this longer term price target. And I think we even talked about it the last time I was on. I had a $6,000 to $6,100 price target. And I want to show you where that comes from. So if we go to logarithmic view, and this is something that I pay attention to, these are the longer term views of the market. But if we zoom back to the 1929 high before the Great Depression and the stock market collapse, and we put a trend line starting there, we connected through the dot-com high. Look at what we're just nibbling on right now. I mean, amazing to think here we are back to a trend line that goes back to 1929, almost 100 years ago. And think about what happened after each of these highs. It does make me a little bit concerned, especially with the tariff talk, which could be inflationary, deporting all the illegals or even others, right? I mean, again, taking away workers means that the current workers generally will have to be paid more. So there are things that are concerning to me. Granted, we have to see if it actually comes to fruition, though.
Can you just go back to your trend line and just zoom out here, and we'll see. Did it touch 2008 at all?
It did not, because that was a double top on the chart, right? So the S&P only double topped there, and you got the big correction right there. So it did not touch the 2008 high. But what's interesting is that so if you look at what caused the Great Depression, it was the roaring 20s, and you had lending and borrowing and margin galore, right? And then you had the collapse in that. And then we go to the dot-com era, which was arguably the greatest bubble of my generation, going back to 2000. That was another massive bubble. And then you look at where we are right now. And the question is, like 2008, you had a housing bubble, but it wasn't as much a stock market bubble that then collapsed. And so it does make me wonder if this trend line more denotes major bubbles in risk assets like stocks versus housing like we saw in '08. Maybe that's why it doesn't touch.
Okay, Gareth, before we talk about technicals and trend lines, just get your sentiment overall for us. So Donald Trump won. We had this huge rally in risk assets. How are you feeling overall? I know that's a very unscientific word, feeling, but sentiment is a very touchy-feely subject. So how are you feeling about risk assets in particular? Are you more bullish now? Has Donald Trump's presidency or win changed your outlook at all? Has it not changed anything?
Yeah.
Or are you just looking at the trend lines and adjusting your forecasts as they go?
Yeah. So the first off is going into this, I didn't know what was going to be the culprit of us hitting 6,000 to 6,100 on the S&P. Obviously, we find out now it was Donald Trump winning the election. The Fed lowered interest rates by 25 basis points. Generally, as a trader, I try to remain logical, which means trend lines rule. But, just there are concerns, right? For me, it's looking at and some of this has to be with being a cynic, right? Is that I don't believe that there's any politician that's going to really stop spending money, because it's just in their interest to make sure that their presidency looks the best, and you stimulate by spending money, right? So until the overall market and people stop buying our debt, I think that I'll be shocked if any president really sees the debt numbers go down. So I am a little bit nervous about these things. I've said with you for a long time, there's been so many people out there that have talked about deflation, and I just never saw it. I'm like, you look at what's going on out there with the debt and how much money is being printed. The Fed's already lowering interest rates, but people are saying deflation. I'm in the camp that we have inflation, and I'm concerned about the tariffs, right? I mean, tariffs, you can argue, are good because it can increase the production of goods here in the U.S., but they also mean that we shut out or raise the price of goods overseas, which then means that we pay the higher price here, and that is inflationary. So I think we're going to be on a trek of inflation beginning to uptick in late 2025, and ultimately, I'm worried still that the economy is still going to take a little bit of a dive, and we could still see stagflation.
If you look at the 10-year break-even inflation rate, it's been trending up. So the market over the past couple of weeks, even before Trump won, was already pricing in higher inflation. And the 10-year has been rising along with that. We can talk about the 10-year in just a minute. But okay, suppose you're right, Gareth. Suppose inflation stays sticky, if not go up slightly from where it is currently, 2.4%. What do you think the Fed's going to do?
So I think this is where it's going to get very tricky for the Fed, right? So you're going to have a Federal Reserve that is going to see a economy and labor market that is slowly weakening. I think then what you're going to see is the Fed say, okay, we want to lower rates even more. And I still think they're going to lower more times, right? I mean, they're not done lowering rates at this point. But do I think rates are going back to 2% on the 10-year? No way. I do not see that. None of the charts show that. Although I do think short-term rates will pull back here, I just do not see it returning to the good old days when money was essentially free to borrow. And you can honestly blame the government, right? It's the amount of debt that we have out there. It's growing exponentially. The U.S. deficit, we now know, is just the interest payments are alone the biggest number in the budget on a yearly basis. And that's only going to increase. And you could argue that, yeah, we need to get those interest rates down because we have to pay this interest on the debt. But remember, we saw the Fed cut 50 basis points and then another 25, and all interest rates did was go straight up. And so it tells you the Fed does not have control, which is a big fallacy, right? Everyone out there thinks that the Fed has control, absolute control of interest rates. They do not. The market ultimately does. The Fed can control it as long as things are normal and calm. But if they lose control of the calmness and the market decides the interest rate.
Take a look at this question from the FOMC press conference last week. Take a listen.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. What is your plan if we start to see stagflation?
So that's the whole plan is not to have stagflation, so we don't have to deal with it. So that is actually our plan.
Okay.
Oh, man. So his plan is no plan at all, but to pray that there's no stagflation. And this is why I say to people this is the boogeyman, right? Stagflation is the worst scenario of all because people are making less, but inflation is going up versus during expansionary periods, inflation goes up, people make more. They can generally handle it okay. Not great, but okay. But I mean, that is not a confidence building answer from Jerome Powell.
The plan is to prevent it. I mean, it makes sense, right? What's your plan if you get into a car accident? If the plan is to not get into a car accident, it's fair enough. But okay, forget that answer. Let's evaluate the economy on its own. We're going to get higher inflation probably. Are we going to get the stag part, slowing growth, the stagflation?
That's the big question. I do think so. So I think that just in the cycles that we've seen, we're approaching that 2029 100-year cycle. We've had this unbelievably long period of expansion in the economy due to all this printing of money. The labor market is weakening, albeit slowly. And let's be fair, there's about half the country that has investments. They've handled inflation amazingly well. They see the wealth effect. They're spending money. And then you have the other half that it can't even afford to go to McDonald's anymore, right? I mean, we've seen McDonald's say, hey, people can't afford to come and even eat here. The dollar store is even struggling. I mean, think about that. So my fear is that if the stock market ever stops going up in terms of, let's say, not, making a new all-time high every couple months, then does that then mean that the upper tier slips into recession and then it all comes crashing down? And I mean, that's not even talking about not only the US debt, but the commercial real estate issues. We're now seeing housing start to struggle as well. Interest rates are obviously not coming down very quickly for housing. And so there's a lot of underlying issues with debt, not just in the US deficit, but also in the private markets.
Yeah, and to be fair, McDonald's is getting expensive, so it's not like
it is.
Yeah,
really
I do I go there or do I just get my groceries? It's tough. So distribution of household wealth in the U.S. since 1989. This is what you were talking about. The wealthy's net worth or household net wealth. It's been rising alongside financial assets, as you can see, and the bottom 50% is just stagnant. So you're right. If financial assets turn south like they did in 2022, direct correlation between financial assets and household wealth in the top 1% and top 0.1%, even the top 10% to some extent, but more pronounced in the top bracket, top 1%, top 0.1%. So Gareth, let's go back to the markets here. Suppose we get 6,100 on the S&P. What happens then?
So that's my upper band of my target price here, and I would expect the markets to top out in this range. Now, granted, there's no guarantees. I've been wrong before. I'll be wrong again, I'm sure. But ultimately, based on probability and chart analysis, that would be where things would start to turn down. I wouldn't expect a dramatic turn down initially because you're going to have buyers that are going to swoop in, especially with Donald Trump being more lenient on businesses, and a lot of the rules and M&A. Lots of these things will be pro-business. But again, it's all going to come down to that stock market. And if we see a prolonged period where the stock market does not make new all-time highs or actually comes in, like if remember August was such a big collapse, if we did not snap back quickly, that could have been the trigger for a recession. And if you look at August, what did we see? Well, in the following few months, we saw the labor numbers actually start to stall out and go down a little bit versus now beginning to kind of stabilize. And so you really see this connection between the stock market.
Stock market, 6,100 points, and then we top out, we stall. What happens to other risk assets? Are we getting a rotation into something like Bitcoin, for example? Let's take a look at Bitcoin. Huge rotation happening. I don't know where the money is rotating from because the stocks aren't going down. So maybe it's just parked cash. We'll see. But anyway, 80,000 points, or dollars rather, not points. $80,000 a Bitcoin. Now, the night Donald Trump won, it reached 75. So basically, the night he won, it already reached a new all-time high. And then, some people on my show were saying, well, that's a contrarian play. Markets priced in a new high. It's time to, people bought the rumor. Now it's time to sell the news. Well, no one's been selling the news because now it's at 80,000. So let's take a look at the charts.
Yeah. So the first thing is the last time we talked about this. I talked about being slightly bullish on Bitcoin because this pattern where you ran up to all-time highs in March, this was all bullish consolidation within a parallel channel. And you can see that once we broke out, look at this. This is the amazing stuff about charts. You broke out, you retraced to the level, which was now support, and then it's just gone up from there. And so, listen, I'm not going to say that I'm uber bullish for 100K or 120K here, because I do think the biggest thing to recognize is that risk assets, it means that Bitcoin generally will trade with the stock market. So as long as the stock market's going up, Bitcoin likely goes up with it. But once we see that correction in the stock market or a pullback in the stock market, Bitcoin likely comes back in. I would still overall buy pullbacks on Bitcoin, especially with, the pro, crypto administration that Trump is. He's going to have RFK in the mix in there, lots of pro crypto stuff. But I, again, wouldn't say necessarily buy Bitcoin at 84,000 today. I think that's a little extended. I think you probably get a pullback to maybe the 74,000 range, and that's where you start to buy.
If we were to just remove these trend lines you drew and then maybe start from the summer lows and draw these trend lines, because I see the trend has been moving upwards since then. Yeah, I mean, does that still make sense? Is it still trading within a reasonable band if you make that a bullish band?
Yeah. So one thing, and you bring up such a great point. I swear you're going to be a chartist in no time here. But look at these little pivots right along here, right? So where you just kind of tag these levels. And so my job as a technician of the charts is to essentially dictate where Bitcoin could pull back. And what we see is Bitcoin, this was support, broke down, resistance, support. So what does that mean? It means that if Bitcoin gets up to this level, this may be the level where there's some profit taking. And that's right around 86,000. So I would be starting to look for a pullback off 86,000, maybe back to 74. And then maybe at that point, the move up to 100,000. That's all assuming, and I want to be clear on this, that the stock market is still staying strong during this period.
Yeah, that sounds a lot like your S&P forecast. A little bit more room on the upside, 6,100 points on the S&P, and then a slight pullback. But here for Bitcoin, you've added a disclaimer that suppose stock markets remain strong, we could still see $100,000.
Yeah,
So
and keep in mind, we're
upside.
seeing, one of the interesting things with this latest run in Bitcoin, right? So if we look at Bitcoin's run from last week from the elections, look at the Russell. Right. So the Russell 2000, look at this run here in the Russell. It's almost identical. And one of the comparisons is you could make a case, even though the market cap of Bitcoin is $2+ trillion, nearing 3 trillion, it's still treated like a heavy risk asset. Right. It moves with the small and the mid caps. And so I would say that, again, more than anything, follow the Russell. And the Russell, interestingly enough, is also approaching a double top up here on the charts. And so that could be also a little bit like 2,000 more on Bitcoin. Maybe the Russell pushes up into this level, and then you get that pullback. And what you'll notice, and you're bringing this up, on purpose, I'm sure, is that in general, these assets will top out together in the short term. Now, I'm still a big believer that eventually Bitcoin is the digital gold. It's just not mature enough yet for that.
We spoke a couple of times since the beginning of summer. And back in July, I'm just pulling up our July 26th interview. You were calling for Bitcoin to have a big up move.
So if we just draw out what has happened here on the chart, we had a big move up, and then essentially what you get is this sideways chop of digestion. And usually what it forms is this kind of parallel channel, which is exactly what Bitcoin is doing here. And then eventually you likely will break to the upside. So if we look at this, the eventual move should be up. And this is exactly what we're seeing here in the Bitcoin chart. If we draw our trend lines in here, it looks very similar to what we're seeing here. Big up move and then sideways consolidation. So really, if you look at this on a big time frame, this is actually bullish consolidation on Bitcoin. And I would fully expect it to make a move to the upside maybe in the next couple months.
Back then, it was still trading around $76,000. Yeah, 76. And you were right in your medium-term outlook, although at the time you were still kind of reserved. Like you were saying, well, it has a big up move from the technical charts, but I would start taking profits at certain levels, right?
Yeah.
So I wonder if that reservation is still there for you.
Yeah. And you said 76. You probably meant 56,000 on Bitcoin during July, right? Because it never was quite at 76.
Oh, yeah. That's what I meant. Yeah, 56,
no
56
worries.
in July, and then 67. 67 was when we spoke. Yeah. My mistake.
Exactly. Yeah. So and I think that's the kicker is that, for me, I'm a shorter term investor and trader. So, you see a 20% pop on Bitcoin. I'm taking some off the table. You can let the rest run with a trailing stop, something like that. But overall, the pattern was just sideways to slightly lower chop from that high in March of 2024. And that, again, in technical analysis, that's known as a bullish consolidation pattern, which, again, you have to favor that upside. And then you just throw the ancillary, deficit, all these other things. And you can understand why eventually Bitcoin would break out here. The question is, again, how high does it go? And do risk assets remain strong enough to keep it going?
So any downside for Bitcoin now? Are you factoring any bearish news or events that could push Bitcoin down to below, let's say, 50,000 or any what's the floor for Bitcoin for you?
So the first floor, and I'm gonna take it in stages. We have a multi-floor apartment building here, but basically once you break out above that high here, all right, this is that March high. this now becomes support, right? So on any sort of retrace, if it gets here, as long as it holds here, you remain bullish, right? So you remain bullish, like, okay, it hits here. Let's see how high it goes. If it ever gets below this 74, essentially, and confirms, that's where you have to start getting a little bit concerned, right? So you use it as the chart as a floor, the trend line here, which marked the previous. And you can even see, here was your high in March. Look at how it hit, was initially rejected, and then broke out. This will now be support. If it breaks, that's where I would start to get scared a little bit for Bitcoin. And my guess, if it ever does break, you kind of come down towards this 58 level right in here. You can see the trend line going back to the October 2023 lows through these lows. But really, when it all comes down to it, as long as it's not the digital gold, then you have to say to yourself, buy support. But if it breaks, stop out immediately. And then watch the stock market. And if the stock market has, if you were to tell me that in a year from now, the stock market's down 50%, I would think Bitcoin's below 50,000 at that point. That would be my personal thought. But again, that requires a big correction in the stock market.
So the underlying assumption is that into 2025, it's still going to trade like a leveraged NASDAQ play. That's what.
Yes, it will. It will. And you can understand why. I mean, if you think about it, is now that you have these ETFs, right? These ETFs have opened it up to a lot of retail investors that probably weren't buying Bitcoin as a risk or as just what Bitcoin is. And so they're investing because they're thinking they should diversify. It still means they get scared when we see the bigger markets drop. And so eventually you'll have enough institutional ownership, and the word of what Bitcoin is will get out more and more, and people will start holding it as a risk off asset. But I don't think we're there, and I think it's still years away, unfortunately.
Okay, let's pull up a gold chart. Gold is not liked the Trump victory. I think a lot of it may have been due to the dollar rising. We can talk about both at the same time, but let's pull up a gold chart first. Gold has hit new all-time highs this year. Pretty much every single time I've spoken to you, except today.
Yep.
Right. It's fallen from its highs. What is going on with gold?
So what's going on with gold is that, number one, the dollar has just been soaring, right? The dollar's up again. And what's interesting is that gold had been going up with the dollar for quite some time because people were so nervous about the election. Was there going to be violence? Was there going to be this? Well, none of that happened. And the dollar is still staying strong. So now you're seeing kind of the bubble is being slightly deflated. Now, I'm still a huge bull on gold long term, and I still think we're going north of 3,000. But if you look at this chart, very clearly you have these lows here, and then this high matched perfectly with this high pivot. In fact, that's where I was shorting gold. So I still have long-term holds on gold where I'm like, okay, this is my long-term portfolio. I still believe it's going to 3,000. It doesn't mean I don't swing trade short when I see an opportunity like this. And again, my guess is we're coming down to about the 2,500 level, which would be the low end here. And you have to flush out all the weak hands. The markets are amazing. They want to test the buyers, the will of the buyers, and they want to test the shorters, right? So they'll push it up ridiculously where the shorts get crushed. And then they want to flush out all those weak hands that bought at the highs here by bringing it back in. And that's for all risk asset. Well, not even risk assets. Gold isn't even a real risk asset, but that's for all assets. And so I think we pull back here. You got to flush out the weak hands. And then I think it stabilizes once we see the new administration and maybe that there's no curb in spending. The dollar may start to weaken at that point, especially if the economy begins to weaken as well. And then I think gold resumes its bull move towards 3,000.
It's a bit of a Freudian slip. You said risk asset. It's not really, but this year it's been trading like a risk asset. It's been spiking all year round. I'm just going to flip over to my screen for just 1 minute before we go back to yours, Gareth. This is gold, and then the SPX is in the purple line here. And you can see like good moves throughout the year, moving in tandem together. And now we're starting to get a divergence. Risk assets are going up and gold's going down. So the question remains, what is gold going to do next? And you answered that with this with your chart. But let me ask you another question. Of the three assets we've talked about so far, gold, S&P 500, and Bitcoin, are you still most bullish on gold like you were in the past?
So that's a good question. So I would say in general, yes, because I hate being the pessimist that I am, but that is my feeling. My feeling is that we are not out of the woods, that ultimately it won't be as soft of or no landing as the Fed believes. I believe that there will be tariffs, and that's going to create potentially inflation. And so I think that those things, as a protector of my own capital, make gold a safer play. It doesn't mean it's going to be the best performer, and I want to be clear on that. But at least in terms of risk reward, which is my job as a guider of my own assets and my family's assets, that's where I will have most of my money, and I'll be buying on a pullback. If it gets to 2,500, if it gets below that, I will continue to slowly accumulate. And by the way, palladium looks interesting. It's coming back finally. I mean, there are other assets, and even silver. I know people love their silver. I'll show you a quick chart on silver here for people to see where the level is that we've just broken down here. And I think this $29 to $28 level right in here is where it's going to be a buying opportunity on silver. That'll be kind of right back. You had this move up, bullish consolidation, breakout, and then retrace right in here to 28 to 29. And I think silver becomes a buy there as well.
Interesting. I just want to flip back to the S&P 500 for just my next question here. I've been getting a few different takes on, where the S&P is going to go. Two interesting theories I've heard. The first is that if you take a look at what the S&P did during the last Trump presidency, between when he entered office in 2017 and when he left in 2021, it's been on an upward trajectory with periods of volatility. There have been periods where the S&P fell, but more or less over that 4-year period, it was bullish up until COVID happened.
Right.
And then so one can make the argument, if he's kind of the same president and the economy behaves in the same way as 2017, it's another 4 years of a bull market. Mm-hmm. The other take is that you can compare this presidency and the political environment to a shift in dynamics similar to what we had when Ronald Reagan won in the early 80s. And if you look at when he won, which was 1980, right? 1980 Ronald Reagan election, we had the S&P 500 rose by another 17% post his victory, and then 26% drop. Mm-hmm. So if you go back to the early 80s, 1980, we had, that drop right after he won. Mm-hmm. Yeah, he was right. What was right is after that.
I would more err on that side of caution, meaning that the first time Donald Trump won, the markets, the futures, and I still remember this vividly because no one thought he was going to win in his first presidency, and the market initially dumped sharply when it looked like he was going to win, and then by the next morning it was off to the races, and the rally began.
That's exactly what happened. So, 1980 was when Ronald Reagan entered office. 1979 was when November 1979 was when he won. So that's a similar situation.
And I think the key is why that is likely to happen is that if he does, and he said he's going to institute these tariffs, right, is that you're going to have tariffs, yes, on foreign goods, but you know what's going to happen? Retaliation. I don't think that retaliation won't come, especially with the level of tariffs that are going to be put on by the Trump administration. And that's going to make China, that's going to make these other countries tack on tariffs to our goods. And what we know is that, for instance, Apple revenue, there's a huge amount of revenue from Apple that comes from China or other places. And so it actually could, in a weird way, be an economic negative, even if it does create more jobs here in the US. But imagine an economic negative that is also inflationary. And there you have your recipe for stagflation.
And we have to remember that suppose we have inflation from tariffs. I know a lot of economists have been calling for higher inflation because of these retaliatory tariffs that you talked about. Everyone's, putting tariffs on each other, prices go up. So then what happens is maybe the Federal Reserve doesn't cut by as much. So what happens to the bond markets then? What happens to yields if, let's say, the expectations for the number of rate cuts don't come into fruition because of these, exogenous shocks like tariffs?
Yeah, and so I'm with you on that, is that I don't think the Fed is going to be able to cut as much as they think they will, because I do think you're going to have that uptick in inflation over the next year or so. And what that's going to do is, again, put the screws to the Fed here, where we start to say, all right, well, now we're in a position where if you have higher inflation but a slowing economy, which is what I think will happen, is that you're going to have longer term rates stay higher, and that's going to really kill a lot of businesses here. So I mean, again, and I don't mean to be a nervous Nelly on the whole thing, but let's take a look at the 10-year yield chart here.
Yes.
And what we can see is we've had this monstrous rally in yields, but look at where it went. Connect a trend line from these highs, connect these lows, and we went what we call right back to the scene of the crime. So yields in the short term, I expect to pull back. But the bigger kicker is this, is if you zoom out, I don't think yields ultimately go below 3.2% or so. And that means that the hope of this free money and easy money policy is not going to go the way people hope it will, where it's back to the great days of post-COVID, where money essentially was free. And it's going to actually take its toll on the overall economy over time, and the housing market, by the way. The housing market's at a lot of risk right now.
Yeah, things have been slowing down here in Canada. I don't know how it is where you live.
Florida's getting bad here. Yeah, Florida's really getting hit.
Well, maybe that's because of the hurricane. I'm sorry.
That too. No, that too. I mean, people don't want to move to Florida right now. And also the home builders, because there was such a boom during COVID, the home builders overbuilt in Florida. So now prices are coming in because of that.
It's so strange how housing markets all across North America, at least in the big cities, are kind of slowing down, even though rates are falling. And then the opposite happened when the rates are, going up in the last couple of years. We didn't have this big slowdown. And now I'm actually, I got a flyer in the mail, Gareth, a couple of days ago. Some Vancouver real estate brokerage sent me some flyers. But anyway, there was a report, and to sum up the report. House prices, or the median home price in downtown Vancouver, dropped 8% year over year. Inventory is down. Home sales in terms of volume dropped 21%. Big slowdown here where I live, and rates are falling. So I don't know what's going on.
No, I'm with you. I think that's correct. So I think rates will come in, but again, people are just assuming that rates are going to go back to the good old days of 5 years ago or 4 years ago.
So they're waiting for lower rates.
Right. And that's what's happening. And the negative is that you have people not wanting to buy because the rates are too high, but it's also the cost. Like, I mean, David, I know you experience this too, but for me as a homeowner, my insurance keeps going up, but not only homeowners insurance, but also car insurance. I mean, these things that crush individuals are just going up nonstop. And then you throw in taxes, real estate taxes, and it's almost unaffordable to own a home. I know it was always the dream, but honestly, to me, I wish I was renting right now. I know renting's not cheap either, but holy cow, considering all these extra costs of owning a home, it does almost make more sense to rent.
Of the assets we talked about so far, bonds, but we haven't closed off on bonds yet. So yields are going where, you think? 10-year.
I think yields in the short term are going to pull back off the technicals, and then max downside. Even during a recession, I have a hard time believing we're going to see below 3.2% on yield. There's just so much technical support in this range. In fact, you could also make a case that you have this downsloping parallel here as well, which will eventually, let's put this in right here. Look at that. So parallel line to this line. And look, they're both meeting at this level where X marks the spot, as we say in technical analysis. That's massive support. And so again, I still see a recession. I just don't see yields going much below 3.2%. And that's going to be very problematic. It could actually create that stagflation issue. And it also could mean a long period of kind of recessionary market conditions.
So you still see a recession. You don't think yields are going to continue rising alongside risk assets like Bitcoin over the last couple of weeks? They've been correlated. You don't think that correlation is going to hold?
Yeah, I don't. I actually think that risk assets, I think the correlation may hold, but then they're all going to go down together. And that would make sense, right? Because if the economy starts to weaken, then you get a sell-off in stocks, but also yields would come down. So
the things we talked about today, Gareth, the dollar, gold, Bitcoin, S&P 500, bonds. We covered a lot of ground today in the last 30 minutes, but of those things, right? Fixed income, equities, Bitcoin, gold. What are you most bullish on in 2025?
Oh my gosh. For the whole entire year.
I know I'll have you back before the end of the year. I should probably ask you this again. That'll be fun. Let's see if you change your mind by December. But anyway, yeah. What's your outlook for 2025?
I would stick with, so for 2025, I would stick with gold if it gets back to 2,500. I think it's still going to come there. So I'm not running out to buy gold here at these levels just yet. And then also the bonds. Bonds, I think with yields staying a little bit higher, I think I'd be somewhat surprised if we don't have a sharp pullback like you mentioned with the Reagan taking into the presidency there and on these type of situations. So I'm expecting at least early in the year some sort of big pullback in the markets, and that should coincide with a Bitcoin pullback as well. And maybe gold at that point starts to get its mojo back and head towards 3,000.
Very good. Gareth, where can we learn from you?
Verifiedinvesting.com. It's the haven of people that want to follow charts and probabilities and not crazy social media and mainstream media. These are the people that you cater to that want real facts. And that's so awesome that you do this show and kind of give people this data. But that's what verified investing is, folks. We chart things, we go with probabilities, and it really gives investors the ability to be logical versus emotional, which is really how you make long-term money.
Excellent. Thank you very much, Gareth. Appreciate your time as always. Check out verifiedinvesting.com to follow Gareth there. We'll speak again soon, Gareth. Take care.
Thanks so much, David. Take care.
And have a great rest of your day. To the viewers, thanks for watching. Don't forget to like and subscribe.